Hello, listeners. This is Roy Damari of INSAM presenting his ramblings for the 3rd of December 2017, and I'll be focusing on some basic economic issues this week. First, I'd like to focus on the implications of the changing shape of the interest curve. Then I'll want to address the reason why the stock market is so high, looking dangerously high. And finally, I want to say a word or two on crypto coins, particularly the Bitcoin. The story on banks is mainly American, but is not limited to the United States because similar phenomena exist all over the place. The phenomenon is that the central banks are gradually pushing up short-term interest rates, like the overnight rate, the 3-month rate. But the long-term rate is really not going up. It's supposed to, but it's not. And so you have a curve which is moving up at the, if you like, the left-hand end, the starting point, but not really moving at the right-hand end. And that's not particularly good for banks. Now, you may not feel sorry for banks. I certainly don't feel sorry for banks, but it does mean that their basic business model is not working very well. You see, what they do in basic banking, as distinct from investment banking and all sorts of other things that they get up to, what they do as the basic banking activity is to take our deposits, our current accounts and our savings accounts, and use those funds to lend. They might lend to individuals on mortgages and to companies to keep them going and that sort of thing. But the interest rate they get from the lending is now rather low, and so the gap between what they are paying to us, the depositors, and what they're receiving from their loans is getting very narrow. The piece I just read spoke about the United States typically giving sort of 0.1% on deposits. My goodness, that's even high by Swiss standards. But borrowers are paying in the order of 3.5 to 4%. That sounds like a good gap, but the gap is getting narrower. And what's disturbing for the banks is not many people want to borrow anyway, despite the relatively low cost of borrowing and the cheapness of money today. People are not borrowing very much. Companies are not borrowing very much. So the narrowing of the spread between the borrowed and the lent money for banks cannot be made up simply by volume, because the volume is not there. Now, already some years ago, I would speak in my talks or papers for Bridport in those days about disintermediation. That fancy word is how large companies can borrow money without using banks. Banks, in this sense, would be acting as investment banks. And they can do that by issuing bonds, and that makes sense because they can issue bonds now with very low interest rates and lock in that interest rate for the life of the bond. In addition, other entities with lots of cash have started acting as a quasi-bank and lending money at rather high interest rates where the banks won't do it or can't do it. In fact, I often wonder why they can't do it if there's so much money around. Specifically, hedge funds have a lot of money, and so do insurers, and they are now able to lend directly to corporations, and indeed the company which I'm involved with in the United States, in Dallas, has taken a loan from a hedge fund. I was rather shocked at the interest rate they were paying, but apparently the banks are so unwilling to lend these days that it was worth paying the extra interest. In fact, I'm still very confused whether the bank's difficulty in lending is because they don't want to lend or because people don't want to borrow. It's far from obvious, and I can't give a very clear answer to that, not least because I keep reading contradictory information or hearing contradictory facts. All this to say then that the structure of the interest rate curve, which in turn reflects the whole process brought about by quantitative easing, is extremely unhealthy and has some effects on the economy which are not at all welcome and which do speak of a long, slow period of growth in the real economy. In the meantime, the unreal economy, if you like, the stock market, is doing very much its own thing and is reaching incredibly high levels. And well, now what's all that about? Is partly because when investors are looking to earn enough interest or coupons or returns on their investment, at least to cover inflation, they cannot achieve that objective with a bank deposit, and they can't even reach that objective of beating inflation by buying into bonds, although there are some which would exceed inflation, but then they would carry a credit risk. So you're beaten one way or the other. Yet the high values of the stock market have a secondary reason, which is really much more sinister than investors moving to the stock market in the hope of getting some return when they look at bank deposits and bonds and say that's not worth having. At least we might get some increase in the value of the shares we buy. There might also be dividends which could be worth having, but the two together make shares basically more attractive for many investors than bonds or bank deposits. The simple approach to share analysis is to look at the price-earnings ratio, the PE, which, if it is not too high and is trending higher, can mean that the stock is worth buying. And one of the components of the PE is, of course, the earnings per share. And if you push up the earnings per share, then automatically, for a given price-earnings ratio, the price of the shares has gone up. That's simple arithmetic. But look hard at the expression earnings per share. If earnings are the same, but you decrease the number of shares, the earnings per share has gone up, again, purely arithmetically. And that's what a lot of corporations are doing. They are able to borrow cheaply if they're big enough, and they might issue bonds to get that money, and then they're using that money to buy back their own shares to create what's called treasury stock, leaving fewer shares in circulation and pushing up the EPS. Therefore, the price of the shares go up and they look like heroes, but they've done nothing for the real economy. There's a disconnect between that operation, the price of the shares on the stock market, and the real economy. And that's, again, one of the great worries of why the economy is not doing anything like as well as the stock market suggests it is. As my listeners will know, I'm convinced that the stock market is in a bubble mode, and I am expecting a major crash. And it's for the reasons I've just sort of spelt out. It can't go on, this creation of apparent value, without real economics behind it. Now, all this bubbling up of the stock market is present in something called the Bitcoin. And that is really a weird phenomenon. And it will go down in history, I think, as a huge bubble, one that deserves the name in the United States of a Ponzi scheme. It's called in French le jeu d'avion, and of course it's called a pyramid scheme in English. Now, what is a pyramid scheme? It's when people buy into something they think is going to go up in value, and the organizers behind the pyramid scheme use the new money coming in to give some sort of reward to the early investors until the new money stops coming in and then everything collapses. All this applies to the Bitcoin, a cryptocurrency, which has been going up in value so sharply recently that a normal curve shows it to be purely vertical. You have to express it as a logarithmic curve to get any sense out of it. The reward of owning a Bitcoin is only increase in value. There is no dividend or coupon coming from it, and that's why people are buying more and more of them. They see it going up. But what is the underlying value? Well, there isn't any. There is no underlying value to the Bitcoin. There is no dividend. So what is there to stop this valuation, this high valuation, actually collapsing? It's got nothing to base itself on. Now, the idea of a cryptocurrency, which is a general term for Bitcoin and its rivals, is that there is money out there which can be used to buy and sell and trade without interference from the government or the tax authorities. It attracted originally quite a number of criminals, and they have been caught, but it's not really that the danger. The danger is that it's a currency with no backing to it. In fact, the Bitcoin is not much being used for trading purposes. Yes, there are some people who will sell you something priced in Bitcoins, but most buyers into Bitcoins do so not to use it for trading, but in the hope that its value will go up. So they buy it and hold it, and then they might buy some more and hold them. So it's a very strange phenomenon. A currency which was meant for trading has actually become a virtual asset. Now, my reading on this tells me that in all likelihood, the price of a Bitcoin will go up still further, but eventually there's nothing there and it will collapse. One thing we can affirm about bubbles is that when the underlying asset does not reflect the price of that asset, it will eventually collapse. The difficulty is deciding when it will collapse. And so I've even read people say, put a bit of money into it, have fun, it's purely gambling anyway, and if you've got a gambling instinct, this is one of the better bets for gambling. Personally, I won't bother, even if I could. Next week I shall be at a conference on forestry in Zagreb, Croatia, and I may give you a report from there. So that'll be another new subject for my ramblings. Speak to you again.